In this video, Jim Cramer analyzes today's Federal Reserve decision to cut interest rates by 25 basis points, noting the mixed reaction from the market, which saw declines after the announcement. He explains that while the Fed aimed to ease concerns about an overheating economy, investors were disappointed by the prospects of fewer rate cuts in the future. He raises concerns about tariffs affecting manufacturing, vulnerabilities in the auto and housing markets, and overcapacity in real estate, highlighting the delicate balance the Fed must strike between combating inflation and supporting struggling economic sectors.
Colossus fell badly after giving what I thought was a disconcerting forecast about PCs and cell phone chips that was way out of whack with what people expected. Homes and semis, both bad, not good at all. So why did the whole market fall apart in response to a rate cut? I mean, I've seen a lot of markets that have been clubbed by rate increases, but rate cuts? At first, it does seem a little baffling, doesn't it? But after listening to Fed Chief Jay Powell this afternoon, I think a lot of people got even more baffled because he seemed to get caught having to fulfill a prediction of the need for a rate cut, and that need was no longer self-evident. The data didn't back it up. Look, this is a tricky situation. There are areas of real weakness in many businesses in this country, but there also is real inflation that hasn't come down enough to merit many more cuts soon. Now, we've been saying that on this show for every night, and you always hope that everyone agrees with you and respects the prospects and has thought, yeah, that's right, I heard it on Mad Money. But it's clear from how the market cratered today that there were plenty of people still hoping for cuts, and those cuts may not come anytime soon. And those people, they were wrong. Why was this such a close call? As Fed Chief Jay Powell told the reporters in that excruciating press conference, always feels like nails on the blackboard. How can you look for progress on reining in inflation while cutting rates? Isn't that a bit of an oxymoron? And that's why nobody seemed happy with the Fed's actions. Those who wanted inflation stamped out immediately were discouraged by a rate cut. Those who want lower rates were discouraged by the implication that there'll be fewer cuts coming next year. Everyone simply confounded, which is why the market reversed so hard when the Fed released a statement, and then Powell followed up with what I thought were some pretty stern comments. Almost made it sound like he's rather raising rates than cutting them. Yeah, I mean, I think he kind of said, well, we had the raise, there's nothing we could do. But he didn't. Of course not. The problem is we have two economies, people, one that's on fire and the other one's that's stalled out. They come together in a way that's very hard to fathom, which makes the Fed's job especially tricky. I always like to put it in the forms of companies because that way it becomes very clear to you. So I want you to consider the travails of a company you may not have heard of, but it's a very big company, and it's called J-Bill. It's formerly J-Bill Circuit. No, it's a $27 billion revenue. This is what's known as a contract manufacturer, but that doesn't capture the incredible breadth of what it does. J-Bill makes everything: electric auto parts, data center components, medical devices, tech, hardware, robotics, you name it. Now, the stock shot up more than 7% today, yes, on this egregious, horrible day, because the company reported such a spectacular quarter and also dramatically raised its full-year forecast for 2025, largely on the strength of data center construction. J-Bill has great cooling technology, which these warehouses full of servers need in order to avoid overheating. CEO Michael Dastor said he expected J-Bill to do $5 to $6 billion in data center revenue. But now it's looking like $6.5 billion. That's up so big. That's largely thanks to customers. People are saying maybe it's Amazon. 30% growth last year. 30%. Anything related to the data center is red hot, and this extends all the way to the electric utilities because we simply need more energy than we have, which requires a gigantic build-out because our current grid won't cut it, and that is actually moving the GDP. At the same time, J-Bill is another business, regulated industries, accounting for just over 40% of its sales. Microcosm again. That's focused on things like renewable energy, electric vehicles. That's down 7%, ice cold. I suspect these businesses, including solar, will continue to be weak. But then again, within the same segment, J-Bill has a pharma business, which is currently doing great because they're helping to build out its client's GLP-1 franchise. Talk about smoking hot again. All right, this is a worldwide company, gigantic global footprint. I mentioned $27 billion in revenues. Its largest manufacturer in Mexico. Under President-elect Trump, that could be a major problem. Tariffs will absolutely slow the growth of American companies. But J-Bill says not to worry. In the past, these tariffs have been largely pass-through costs. So you get this all within one company. In the end, J-Bill's the indeed microcosm of our economy, although the stock's ultimately soared because there's more exposure to the hottest industries out there. How about the ones that don't, though? J-Bill represents the part of the stock market that is smoking hot. But it seemed like it just hit that many other companies hit an air pocket today after the Fed spoke, and they could be very vulnerable to even lower prices, despite the fact that the Dow's had so many down days that it's now back to where it's the longest streak of down since 1974. Okay, then there's another side to this story, and that's the industrial economy. Residential and commercial construction away from the data center and the power grid. We have a surfeit of commercial properties, especially office buildings. We have way too much capacity in this part of the economy. It needs rate cuts. Then there's autos, gigantic part of the economy. It's directly or indirectly responsible for 4.1 million jobs. Autos are in a real slowdown. Inventory's rising. When inventories get too high, you get weaker sales, ultimate layoffs. Fed doesn't want that. Again, rate cuts needed. How about housing? We saw Lennar tonight. We've got two problems with housing. First, we aren't building enough homes to meet the demand, but home builders are reluctant to build more lest they can be caught with excess inventory in an environment where long-term interest rates have been stubbornly high. When we consider the Fed statements, their worries seem justified. So we won't get the new supply we want. Worse, we have the least turnover in housing in 30 years. Like the autos, housing needs lower rates to get things moving. The Fed's comments, coupled with Lennar's earnings, well, let's say it's going to put a real hex on housing. It will be ugly tomorrow. Needs rate cuts. When housing and autos and commercial construction are weak, you get softer numbers from the materials companies, the service companies involved in the buying and selling of homes, as well as the home improvement retailers. These groups all need help from the Fed, and it doesn't look like they're going to get it. But against that, we have persistent inflation in food, insurance, healthcare, and rent. It gets even more complicated when you consider what the Fed isn't supposed to be worried about yet, immigration. The immigrants who come here from all over the world are integral to the economy because our country doesn't produce enough workers on its own, and we don't have enough robots yet to do anything. At the same time, immigration puts upward pressure on housing because everybody needs somewhere to live. Less immigration means wage inflation, but housing deflation. I'm talking about tricky for the Fed, tricky for you, tricky for me. Now, let's throw in a couple of issues that the Fed might not be worried about, but it should. Rampant speculation right now in the financial markets, right here. Endless run-ups in nuclear power, commercial space, and amorphous groups like quantum computing. The speed of the rally in Bitcoin can worry you. Those club members who read my Sunday think piece know that I think this kind of speculation is my principal concern about the market, and it is coming home to roost. So you see the pattern. Some could look at the economy and say the Fed's simply fanning the flames of inflation with this rate cut. Others will say that without fanning the embers, the fire's about to go out. Or to put it another way, we could all understand the price of eggs and coffee keep going up. But what is the Fed going to do about it? Plant coffee beans and grow chickens? It can raise rates so high that we won't have enough money to afford a cup of Joe at Dunkin' Donuts, let alone Starbucks. Eggs, yolks, bear free anyway. Sure, we can ask why doesn't a new insurer come in and take advantage of these high rates and offer something affordable? Why can't we cut out the middlemen and pharma as we see it saves money, as so many legislators tell us? We might be able to estimate that more planes from Boeing will bring the price of travel down. But when? In the end, I really wish the Fed hadn't been so definitive about the need to cut rates going forward, albeit more slowly. We would have been much better off if they'd explicitly taken a wait-and-see approach before this meeting. This time they telegraphed the wrong thing, hence today's meltdown. But if the part of the economy that's not so hot gets worse or inflation comes down, the Fed does have more room to cut. Here's the bottom line. A previously data-dependent Fed chose not to be data-dependent today with its pronouncements. And that's what drove the market down in spite of that quarter-point rate cut. Something that's supposed to be good news for stocks, but it turned out to be the very opposite.
The House of Pain.
Jack in New York. Jack.
Hey, Jim. Thanks for taking my call. First time, long time.
Excellent. Excellent.
I got a question on a company I've held for a little over a year. I'm in the House of Pain, actually, with this company. Since November, it's been steadily declining. And there hasn't been any bad news, although I think it's caught in the Doge effect. My company is LHX L3 Harris. I'm just wondering if I should buy more here on the dip, hold it, or just dump it.
You know, we're getting word, look, there's a problem with continuing resolution. We're getting the shutdown of the government kind of stuff again. And the Defense Department is a natural place that people want to cut back, even though you and I may think that they shouldn't. But that's what you're seeing, and that's what you're getting with the idea that we've elected a president who has said, listen, we're going to put an end to some of these wars, and that is also driving it. But don't worry, there are many other stocks in a similar situation. That's more of a misery love company thing. I'm sorry I said that. But what can I say? It's going down for a reason. Jimmy in Kentucky. Jimmy.
Jim, with promised deregulation next year and Basel III and hopefully earnings will be positive next year, what do you see with Bank of America? Do you see it maybe thinking 450?
Well, I think the Bank of America is now going to be in that situation where we have to readjust, knowing that there are not going to be as many rate cuts as we thought. We thought there might be 3, 4. Now it looks like 2. Actually, of course, if you watch the show, we always thought there'd be like 1 or 2. So we think that the stock's probably fairly valued. Goes under 40, I think you have to. Buy. Paul, Minnesota. Paul.
Cramer, you bald-headed beauty, how you doing today?
Well, thank you for getting me correctly, as actually as I see myself each morning. How can I help?
Hey, I'm riding out of Minnesota winter down here in Florida, and I am perplexed. My favorite stock I own is down from a high of 146 down to 113. I bought it at first time at 44. I bought it again at 66. The stock is Vertiv Holdings. Do I buy it tomorrow morning?
Okay, no, you don't want to buy it tomorrow morning. Here's why. Because there are a lot of people who are looking at this stock. It's up 137% for the year, and they're saying, you know what? I better lock something in because I think the market's going to be bad. Now, that is not necessarily the case. But remember, we have to adjust to what people are going to react to, not just what we think, even when we will, in the end, be right. Okay, look, I just wish the Fed hadn't been so definitive about the need to cut rates before the meeting. Think about, we'd be in a much better place if they had just taken that explicit wait-and-see approach that they told us they would. Well, man, tonight, I'm checking the rideshare space with CEO of Lyft. Get a read on third-quarter earnings, self-driving cars, and more. Then we're continuing our series on opportunities in healthcare, taking a close look at the life sciences stocks as they get shelled. And could trash be a treasure for your portfolio? I'm sitting down with Republic